2020 was perhaps one of the most pivotal years in Bitcoin's storied history. It was the year when many of the naysayers, no-coiners, and other CeFi charlatans were put in their place. A year where it managed to eliminate the doubts of many and reinforced the beliefs of many. The beliefs that it is an unstoppable force. However, I think this was just a warm-up, a precursor to a paradigm shift that could happen in 2021. Now, I'm no hopium peddler, but if you watch this entire video and aren't bullish for next year, well then, I will have clearly failed in my mission. High stakes, right? Pfft. Let's get this show on the road. Just had a call with my lawyer there, and he told me to tell you that I am not a financial advisor. He said I must also stress that everything on this channel is educational and should not be interpreted as investment advice. I know, he's quite a stickler for formalities. Now, for those of you who are new to this channel, a warm Coin Bureau welcome. My name is Guy, and over here, I bring you everything you just need to know about crypto. Guides, reviews, news, analysis, overviews, and so much more. So, if this is the kind of content that you soak up, then tap that subscribe button. Pinging that notification bell will also make sure that you don't miss a single video. Crypto markets do move quickly after all. Finally, if you glance at the timeline right over here, you will see that I have placed these handy timestamps. Those are there for your convenience, should you wish to jump around to different sections of my analysis. Okay, that's enough with the pitter-patter. Let's get on to what matters. Perhaps one of the biggest developments this year for Bitcoin was the rapid adoption of it by institutional investors. Long gone are the days when it was viewed as a cypherpunk's plaything. No longer is it thought of as magic internet money that's used by drug dealers and fiends. Large investors are piling into the asset class as they seek to diversify their risk away from traditional allocations. Up until recently, it was mainly hedge funds and family offices that were investing in Bitcoin. They generally had more leeway when it came to investing in more risky asset classes. However, this investor profile is about to change considerably and expand to numerous other institutions. Case in point, we recently heard the news that Mass Mutual had invested a cool $100 million of fund money into Bitcoin. But the actual amount that they invested is of much less importance than to what it could mean. Allow me to explain. Firstly, you should note that Mass Mutual is a life insurance fund. These types of investors are generally more risk-averse than those which invest money for high-net-worth individuals. They are tasked with capital preservation and steady growth. Basically, they're trying to match future liabilities with cash flows. The same can be said about pension funds and other types of insurance companies. Now, why is this important? Well, the assets under management, AUM, of this is absolutely gargantuan. Just to give you an idea of how much that is, Mass Mutual themselves have over $234 billion AUM. That's 65% of the entire market cap of Bitcoin. But Mass Mutual pales into comparison when viewing the larger insurance industry. It ranks about 7th compared to some of the larger US-based insurers. Take a look at Prudential Financial over there. $896 billion in AUM at the end of last year. And those numbers over there are just for the insurers in the United States. If we take a look at the size of this industry outside of the US, global insurance AUM stands at about $13 trillion. Imagine that they just invested a small fraction of their AUM into Bitcoin. This is actually a point that was raised in a JP Morgan research report released after the Mass Mutual announcement. It's potentially game-changing. But that's just the tip of the iceberg, my fellow hodlers. What about global pension funds? The OECD estimates that there are over $50 trillion of assets held by these funds. Why would they not take a nibble at Bitcoin? They have relatively similar risk profiles as insurance funds when it comes to future obligations. I think it's entirely plausible. As inflation starts running rampant, the cost of retirement for these pension funds in 20, 30, and 40 years' time will be high. They will need some strong alpha in their risk bucket in order to meet these obligations. So yes, I think insurance and pension funds are likely to start dipping their toes into the market really soon. All you really need is one fund like MassMutual to destroy the stereotype, and some more are likely to follow in 2021. Now, at the expense of sounding like your late-night infomercial salesman, but wait, there's more. This was just those institutional investors. What about your large corporate custodians and crypto businesses? There are 3 companies that are likely to be the biggest players in crypto next year. These are Grayscale, PayPal, and Square. These 3 companies are hoovering up an unprecedented amount of Bitcoin in order to service their clients and users. Let's take Grayscale, for example. Already they have accumulated $10 billion worth of Bitcoin. That's about 3% of the total BTC that is currently outstanding. The pace at which these guys are buying up Bitcoin is so fast that in some months their purchases outpaced the amount of Bitcoin being mined. Take a moment to think about that. All of the coins that are being minted are technically already spoken for. New supply is rarely hitting the market at all. And that is just Grayscale. Let's take a look at PayPal and Square. PayPal has over 340 million users, and they have over $650 billion in payment volume. Square has 30 million users with over $100 million in volume. As we know, Square got on the Bitcoin payments train pretty early, whereas PayPal only recently started offering it. Now, the reason that this is important is because these services will act for custody of the millions or billions of dollars of Bitcoin that their users hold. To give you an idea of this demand, only a few weeks after PayPal launched their service, over 20% of all their users had bought Bitcoin. This obviously has translated into purchases by PayPal on behalf of their users. I want to draw your attention to this graph over here by Pantera Capital. It shows the explosion in purchasing volume on Itbit, the exchange servicing PayPal. They have extrapolated the PayPal purchases out into the new year over here. To quote the report, if their growth persists, PayPal alone would be buying more than half of all the newly issued Bitcoin within weeks. So, in 2021, we're likely to have a situation where just Grayscale and PayPal will have monthly demand more than twice exceeding the Bitcoin being issued. Crazy, right? And then, of course, we have Square, who are also duking it out for monthly Bitcoin purchases. Let's also not forget that these guys use some of their own company funds and balance sheet to buy $50 million in Bitcoin. What this all means is that the demand for monthly Bitcoin so outstrips supply that these guys are going to have to go to the open market to buy some. Between them and the institutional investors I mentioned earlier, they will be begging us hodlers for some of our sats. Okay, so I hope I've got you folks pretty convinced just how scarce this damn asset is. But in case there was even a modicum of doubt in your mind, there is one more ingredient we need to throw into the dish. You also have to consider demand from those corporates that may not specifically operate in the crypto markets. I'm talking about your Fortune 500 companies with massive fiat balance sheets. This lot are no doubt looking for a way to diversify the inherent inflation risk that exists from holding cash. It's actually a topic I covered in depth on my video on corporate adoption. That's linked to in the top right of the screen, by the way. Anyway, in that video, I took you through the vast oceans of untapped fiat that's sitting on those balance sheets just waiting to be unlocked. The main innovator in this space was, of course, MicroStrategy, the business software company. They made all the headlines this year when it was announced that they had invested $425 million of cash on their balance sheet into Bitcoin. But turns out that MicroStrategy actually had something more up their sleeve. About 2 weeks ago, they announced that they would be issuing $650 million in debt through a convertible note sale. What's pretty crazy about this is that in their issuance document, they stated that, quote, MicroStrategy intends to invest the net proceeds from the sale of the notes into Bitcoin. Yep, they're taking out debt to buy more Bitcoin. Once they've issued that $650 million in debt, they're going to have to return to the market to buy that Bitcoin, most likely to occur next year. But, as covered above, Bitcoin has a teeny tiny supply shortage. So yes, things are likely to get pretty heated next year as they compete with all these other players. What's more interesting than what MicroStrategy is doing, though, is their rationale for doing it. I covered this in my video on corporate adoption, but it's basically a sound argument for treasury management. If only a small handful of other companies in the S&P 500 were to employ a similar strategy, then the ensuing demand is likely to be monumental. And where are they going to get that supply? Well, from the market, of course. And as we all know, if demand exceeds supply, price will react. I do wonder though, I wonder if there are any other potential entities that could have Bitcoin in their sights. Entities that have so far been discounted. Central banks do exist, and they do need reserve assets that can hold their value. Now, I know what you're thinking. Guy, central banks are the arch nemesis of Bitcoin. Why on earth would they purchase Bitcoin? Well, hear me out. Foreign central banks hold a variety of reserve assets, but a large percentage of those are, of course, US dollars. That's why it's referred to as the global reserve currency. But why would these foreign central banks want to hold an asset that's slowly depreciating at the rate of inflation every year? Why would they feel comfortable holding a currency where the actions of another entity, the Fed, can impact on the value of their reserves? Not really logical, is it? In fact, there are a growing number of foreign central banks that were looking to move away from their USD exposure. This was last year, even before the fractious geopolitics that we've seen post-COVID. Which currencies could they diversify to? Well, they could look at euros, won, yen, etc. However, these are still fiat currencies, which would mean that the value of these holdings would be impacted by the actions of another central bank. Of course, you may say gold, given its store of value status. However, if you've seen my video on Bitcoin versus gold, you'll know that that argument does not hold water. That's linked to in the top right of this screen, by the way. Yes, Bitcoin could be an alternative store that these central banks could consider. In fact, if we were to look at the global M1 money supply, Bitcoin comes in at 15th in terms of the global stock. Why should a central bank consider holding a currency that's impacted by the policies of others, when they can hold a currency that is hard-coded? A currency that cannot be changed, inflated, or seized? It's a compelling argument that would make sense if these central banks were rational. It would be a logical diversification play, especially for some of those central banks in emerging markets with volatile currencies. Let's also not forget that the IMF has taken an increasingly more dovish tone towards cryptocurrencies. As we know, the IMF usually has a pretty strong influence when it comes to international monetary policy recommendations. Now, I must caveat that this is all conjecture. It's much less likely than that institutional and corporate adoption that I mentioned earlier. However, if I told you a year ago that we would see Bitcoin in the portfolios of insurance funds and on the balance sheets of large corporates, you would have been skeptical, right? It's crazy what can happen in a year. Moving on. So far, I've only been talking about potential investment demand that could be incoming for Bitcoin. It still leaves out a large component, and that is utility demand. Utility that comes from using Bitcoin as it was originally intended, a fungible and anonymous peer-to-peer digital cash. Now, it's quite clear that currently Bitcoin is falling short of these ideals. Transactions are pretty slow, expensive, and easily traceable. This all comes down to Bitcoin's bloated and transparent blockchain. However, there are some very important tech changes that could take place next year. Changes that could give Bitcoin further usability and anonymity. These are Taproot and Schnorr. No, not those. I am, of course, talking about the long-awaited Bitcoin Improvement Proposals, or BIPs. These will improve transaction efficiency and privacy through Schnorr signatures. I don't want to get too much into the weeds on these, but here is a quick 30-second overview. Schnorr signatures are a unique way to batch transaction signatures so that multi-sig and single-sig transactions are indistinguishable. So, how does it improve privacy? Well, this will enable the aggregation of signatures that could flow through coin mixing methods such as CoinJoin. This obfuscates Bitcoin transactions and hence makes it harder to identify where coins were sent. Apart from the Schnorr signatures, you also have an upgrade in Bitcoin's programming language through TapScript. This will allow for more complicated scripts to be run on Bitcoin. I've linked to some resources below should you want to read up on these a bit more. But basically, what this means is that it could increase the demand to use Bitcoin. The Schnorr signatures makes it more private, which means that the privacy hawks may have more incentive to use it. Similarly, the TapScript upgrade could enhance Bitcoin's smart contract capability and also changes some limits for resource requirements. These BIPs are likely to be implemented through a soft fork in early 2021. That's because we've already seen 82% of the miners indicating their support for the upgrade. Now, even if these Bitcoin upgrades don't see a flood of utility demand, there are a number of interesting trends that have started to take shape this year and are likely to continue in 2021. One of these was the increasing tokenization of Bitcoin. We saw an explosion of Bitcoin being wrapped and tokenized on Ethereum. There is now over $2.6 billion of BTC wrapped in tokens such as WBTC, RenBTC, and numerous others. These tokens have essentially unlocked the entire DeFi world for Bitcoin hodlers. They've also created a medium through which users can easily send Bitcoin much more cheaply and faster than they could do on-chain. And this is just the tokenized Bitcoin on Ethereum. I think that next year we're likely to see a number of other smart contract blockchains launch their own tokenized Bitcoin variants. Blockchains that may be even more efficient than Ethereum. And even if we don't see much adoption on other chains, Ethereum 2.0 is moving ahead nicely. The efficiency gains that this could bring to the network means that sending tokenized BTC could really be like lightning. And speaking of lightning, I know that there are many Bitcoin maxis who look at tokenized Bitcoin with dirty stares. The Lightning Network is the only payment side channel that they would consider. And there has been a great deal of work that has been done to make Lightning that much more user-friendly. However, while I would also love to see some more adoption over here, that's just not the case. You only need to take a look at the amount of Bitcoin that's been locked in the Lightning Network. If we were to compare this to the amount that has been locked into WBTC, for example, it's like chalk and cheese. I would love to be proven wrong, though. And if there is a flood of Bitcoin into the Lightning payments channels next year, then that will no doubt increase its usability and hence make it a valuable payment medium. Okay, so I've been making a pretty strong case for Bitcoin next year. But it would be irresponsible of me not to at least explore some of the potential risks that it could face. And these risks are not hackers, whales, or other attackers. I'm talking about the short-sighted moves by those darling regulators. So, let's take a look into that. Perhaps one of the biggest black swans for Bitcoin regulation at the moment has to be the potential for a wallet KYC mandate from the Treasury. Yep, Mr. Burns over here wants to leave us with a turd on his way out the door. For those that don't know what this is, it's basically a mandatory wallet KYC for all US-based exchanges. Basically, exchanges would not be able to take deposits unless they could fully identify the individual behind that wallet. Of course, I don't need to tell you the logistical impossibilities of doing that. So yeah, that's one potential fly in my hopium ointment. Another one could, of course, be those changes to the travel rule under the Bank Secrecy Act. There is basically a proposal by the Financial Crimes Enforcement Agency, FinCEN, that would lower the mandatory reporting requirement of cross-border transactions from $3,000 to $250. What that basically means is that crypto exchanges will have to keep a record of every single transaction that has taken place which exceeds $250. I honestly don't know which is more burdensome between this and the KYC rule, but they are both pretty archaic and short-sighted AF. Of course, let's not forget that these proposals have been put forward by an administration that is on its way out. Now, given the acrimony that has resulted from this election, I somehow don't seem to think that the new Treasury Secretary will be keen to follow through with any last-minute legislation Mnuchin leaves on the desk. And when the Biden administration does commence, they will have so much else to focus on that arduous crypto regulation will be the least of their concerns. In fact, I happen to think that his administration could be more open to cryptocurrency. I actually went into this in depth in a separate video, which is linked to in the top right corner of this video. Now, irrespective of who is president, there are a number of crypto allies already in the House or Senate. For example, over in the US House, 4 representatives wrote a letter to Mnuchin expressing their concerns about the KYC rumors. There are also many other Bitcoin proponents in Congress, including Senator Cynthia Lummis, who was recently elected. She's promised that when reaching Congress, she wants to educate fellow members on the benefits of Bitcoin. Now, I know a politician's promises are sometimes worth less than Tron tokens, but in this case, she is actually a Bitcoin hodler, so she has put her money where her mouth is. One can be pretty confident that she will fight against any proposed burdensome regulation. So yes, I think that there are risks from these last-minute regulatory pushes, but I think that they're way less likely than the media makes them out to be. Let's hope that some common sense does prevail over there on Capitol Hill. That is about it for my Bitcoin overview for next year. And if you are not bullish yet, well, then allow me to round off with a few closing thoughts. Price is mostly a factor of supply and demand. When the latter exceeds the former, you have a price increase. And as I've shown in this video, we are likely to see an explosion in demand for Bitcoin. This demand is likely to come from some of the biggest pools of capital in the world, from insurance funds to pension funds and possibly central banks, from custodians to corporates and high net worth individuals. All of these market participants are feeding from the same trough as you and me. The only problem is that there is a limited amount of grub to go around. Block rewards are defined and will tail off as we approach that magic 21 million number. All these market participants are likely to start bidding up the price of Bitcoin as they try to fill their desired allocations. Yes, there are those risks that I've pointed out, but these are minimal and, I think, a little overblown. Naturally, hysteria and clickbait sell. So, are you bullish on Bitcoin next year? If so, welcome to the 21 million club. It's going to be one hell of a ride. That's as much as I have to say for this video, folks. I hope I've left you with a strong sense of hopium. Now, what do you good people think, though? Are my predictions fair? Anybody out there want to venture a price prediction? Fire your comments below. Oh, and while you're down there, you may want to check out my personal deals page. This includes some of the best deals and promos in the crypto space, exclusively for viewers of this channel. It's also where you can get your hands on this epic moon merch. So yeah, that's below too. And if you've made it to the end of this video, I assume it was mildly useful. So smash that like and hit that subscribe button hard. Let YouTube know that you know what you want to watch. I have a lot more coming and you don't want to miss it. Oh, you guys still here? Well then, I may as well let you in on a little secret. What I covered in that video was only the tip of the iceberg. There's a whole lot more included in my weekly email newsletter. It's basically a compilation of all the interesting content that may have flown under your radar. News, reviews, analysis, as well as a breakdown of my personal portfolio. Want to join? Well, don't delay. Just scoot on over to the description where you'll find a link to my sign-up form. There, you can enter your email address. Hit submit, confirm your email, and hey presto, you are a Coin Bureau insider. My next newsletter is being worked on as we speak, one you won't want to miss. See you next time, folks.